Nokia, NOK, was one of the names caught up in the retail division January short squeeze mania. However, like most short squeezes, the boom was short-lived, and the stock came tumbling back down to pre-squeeze levels. But Nokia's gains were ephemeral, and the stock price remains down about 4% over the past 12 months. As that volatility ends, investors might be wondering if it is still a worthy investment. In this video, we will tell you, is Nokia stock a buy right now? Number 6. Challenges despite an attractive 5G opportunity. The 5G infrastructure market in which Nokia operates seems attractive. According to the research outfit Markets and Markets, it should grow in a compound annual rate of 67% to $47.8 billion by 2027. Yet the 5G and network specialist has been dealing with significant difficulties over the past several quarters. As an illustration, it lost a $6.6 billion contract to Verizon Communications in September to Samsung for the supply of 5G equipment. The U.S. telecom service provider remains an important customer for Nokia, but that event highlighted Nokia's declining competitiveness because of issues in integrating acquisitions and aligning research and development with customers' demands. Management expects to maintain market share in 4G and 5G mobile access, mostly antennas, at 27% by the end of this year, though. However, that forecast excludes China, where the company has become more prudent because of the uncertain profitability in that large market. Thus, Nokia posted unimpressive results during the last quarter, with revenue down 3% at constant currency to 5.3 billion euros. Number 5. Late investment in 5G and networks. Last week, new CEO Petka Ledmark communicated the company's updated strategy to improve competitiveness. In particular, he plans to better align investments by focusing on areas where Nokia can lead and generate profits instead of trying to provide end-to-end solutions. It remains to be seen whether Nokia will be able to make up for its delayed 5G investments against competitors such as European peer Ericsson, Nasdaq, ERIC. Indeed, Ericsson has been ramping up its research and development efforts to increase its competitiveness in the 5G market way before Nokia, which resulted in a gain of market share outside China from 32% in 2017 to 36% in 2020. On the networking infrastructure side, Nokia will focus on critical networks by leveraging silicon and software technologies that offer customers extra flexibility compared to legacy monolithic offerings. Those choices will allow the company to remain competitive, but Nokia may be late again as networking vendors have already been embracing those technologies for quite some time. Number 4. Reviewing Nokia's challenges. Nokia sold its mobile phone unit to Microsoft in 2014, then purchased its rival Alcatel-Lucent in 2016 to expand its networks business, which provides telecom equipment and services to carriers. Nokia's $16.6 billion acquisition of Alcatel-Lucent expanded its portfolio and increased its market share. However, Nokia focused too much on cutting costs as it integrated Alcatel-Lucent, which caused it to fall behind its rival in 5G investments. It suspended its dividend in late 2019 to free up more cash to strengthen its 5G business, but the 11th hour effort was too little too late. As a result, Nokia's market share shrank as big wireless carriers upgraded their 5G networks. Between the end of 2019 and the third quarter of 2020, Nokia's share of the global telecom equipment market fell from 16% to 15%, according to Del Oro Group, putting it in second place behind Huawei. Huawei's share rose from 28% to 30%. Ericsson's ERIC share held steady at 14%, and ZTE's share increased from 9% to 11%. Chinese tech giants Huawei and ZTE both face blacklist and sanctions, but they both offset their overseas losses with gains within China. That's probably why China Mobile, the country's largest wireless carrier, dropped Nokia from its second round of 5G upgrades last year. But Ericsson, which streamlined its portfolio to focus more on selling radio access network gear, didn't lose any major contracts in China. Number 3, a murky future. Nokia's CEO, Rajiv Suri, resigned last July and was succeeded by Pekka Lundmark, who previously led the Finnish energy company Fortum. Nokia's revenue fell 6% and decreased 4% in constant currency terms in 2020, but its gross and operating margins improved, and its adjusted earnings grew 18%. By comparison, Ericsson's revenue rose 2% and grew 5% in constant currency terms in 2020. Its gross and operating margins also expanded, and its earnings jumped nearly eightfold. Nokia mainly attributed its decline through 2020 to soft demand for its network deployment and planning services, which was only partly offset by higher demand for its 5G radio access products. By region, Nokia's double-digit revenue declined in the Latin America, Asia Pacific, and Greater China regions offset its tepid growth in other markets. Nokia now excludes China from its 4G, 5G market share calculations, which suggest it's surrounding the market in Huawei, ZTE, and Ericsson. In Nokia's annual report, Lundmark said the company expects 2021 to be challenging, a year of transition, with meaningful headwinds due to market share loss and price erosion in North America. Lundmark also warned that Nokia would need to make further 5G R&D investments in 2021 and sacrifice some short-term margins to stay competitive. Faced with those challenges, Nokia doesn't plan to reinstate its dividend anytime soon. Nokia expects its revenue to decline 0 to 6% in 2021, with a comparable operating margin of 7 to negative 10%, compared to 9.7% in 2020. Analysts expect its revenue and earnings to decline 2% and 23% respectively for the full year. Ericsson is faring much better than Nokia. Analysts expect Ericsson's revenue and earnings to rise 3% and 6% respectively in 2021. Ericsson also posted a much higher comparable operating margin of 12.5% in 2020, and it continues to pay its dividend. Ericsson looks healthier than Nokia because it isn't struggling with acquisition indigestion. It wisely ramped up its 5G investments at the right time, and it divested its weaker businesses. Those strengths put Ericsson in a better position to profit from a secular growth of the 5G market, and it might gain more business from former Huawei or ZTE customers in non-Chinese markets than Nokia. Number 2, Nokia stock in 2021. At its recent Analyst Day, Nokia disclosed 196 5G commercial agreements and 55 live networks versus 63 and 18 respectively at the time of our launch, 20 new RAN customers, and increased share at another 22. The five-star analyst said progress on deployment of RF and baseband ReefShark chipsets has been better than expected as well, ending CY20 at 43% of 5G systems with a target of 70% this year. The company also announced a 5G C-band deployment deal with AT&T and said it plans to reduce the headcount by as much as another 10,000 in what the company is calling part of its reset. Moreover, there has been a new emphasis on a best-of-breed competitiveness versus reliance on end-to-end, which analysts believe is positive. So is a focus on differentiating core IC technology across all aspects of the mobile and network infrastructure businesses. These span from mobile ReefShark to optical PSE-V, from routing FP40 to fixed access Quillion, Therefore, when looking at Nokia's wide-ranging portfolio, analysts see potential for synergies and believes the company is well positioned to compete. With the shares trading under 1x Rev and the sum of parts analysis still compelling, the analyst summed up, we think it's likely that the shares are at higher levels a year from now, even absent strategic catalyst. The rest of the street also believes shares are about to push higher. Going by the $5.21 average price target, the forecast is for 28% gains on the one-year time horizon. Rating-wise, the analysts are split, with 3 buys and holds each. The stock qualifies with a moderate buy consensus rating. Nokia trades at about 17 times forward earnings, while Ericsson has a slightly higher forward PE ratio of 20. But Nokia is cheaper for obvious reasons, and Ericsson's strengths easily justify its higher multiple. Investors should have sold Nokia when it popped in late January. Those who didn't should expect another sluggish year as the company tries to keep pace with its better-run rivals in the competitive 5G market. Number 1. Does that make Nokia stock a buy? In Q4 results, Nokia managed to beat the revenue estimates and hit 6.57 billion euros in sales. The net sales grew 1%, and the operating profit saw a decline of 41% year over year. What is notable here is that the company is free cash flow positive, which means it has enough money to put into dividends, partnerships, and 5G rollout. Due to the pandemic, it could not roll out its 5G network in 2020, which had an impact on revenue and growth. But Nokia did not give up. The company is already on its way to make it big with 6G. It is working on a team of universities and companies in a project to build 6G mobile technology. Known as HISA X, it will be a new generation of mobile tech. If Nokia makes a breakthrough with 6G, it could open the door to huge opportunities and take the stock to new highs. Furthermore, NOK recently partnered with ELSA in a private mobile network push. The companies will collaborate to help Finnish organizations accelerate digitization. It also has an ongoing partnership with IBM for deploying 5G. This is a clear sign that the company is making the right strategic moves, and it could pay off in the long run. It has the resources to deploy when it comes to partnering with organizations across different countries. Even if there is no significant achievement with the 5G rollout, the company has enough contracts to continue the momentum. Nokia cannot be written off. It has a huge potential for 5G and is valued reasonably. If the company can execute well and deliver on the potential, the stock does have an upside. The only problem is that one cannot put a timeline on it. How and when 5G will roll out or when 6G will enter the market is something nobody can predict. To conclude, I believe that the partnership with IBM and 6G potential is a good reason to add NOK stock to your portfolio. With a market capitalization of $23 billion, the stock is well priced. For now, it should be a small part of your portfolio. Do let us know in the comment what you think of this stock. Please subscribe to the Stock Advisor. Thanks for watching.